Find me a single other asset that's going to give you 100x asset.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
What's up, guys? Jay Martin here, CEO of Cambridge House, and today I sat down with Raoul Paul, the founder of Real Vision TV and the author of Global Macro Investor. Raoul is super smart. We talked about everything from gold, US dollars, Bitcoin, and the general state and forecast of the markets. I had a lot of fun. I hope you guys enjoy this. And if you do, please click subscribe. And then in the comments, let me know who you want to hear from next, and I will go get them. Thank you. I mean, there's so much I want to talk to you about. So I'm sure Natalia told you I've got you booked for the next 5 hours, right? We're good there? Okay, so to jump in, I wanted to ask you, first how you got into this line of work, and I heard a story. You can tell me if it's true or not. That you had just finished school. It was like 1990. You were debating what direction you wanted to go, and your father worked in marketing. Told you, Raoul, there's always going to be work in marketing. You should do that. But maybe at a barbecue or somewhere you bumped into a family friend and he said, yeah, if you want access to Mars bars, then get a marketing job at, Nestle or whatever. If you want access to cash, work in finance. Is that true?
That's exactly true. Now, the only problem with that great piece of advice is, I had a degree from a really crappy university. It was the only university that accepted me. Okay. So that wasn't very useful. And it was a recession, 1990. Banking recession, remember the savings and loan crisis in the US, everything else. And so trying to get into a bank then was not easy.
Right.
But I tried through the back door, through the side door, any other way. And eventually I got a job with a company called Dow Jones Telerate, which is now part of Thomson Reuters. I think Thomson bought them first and then they merged with Reuters. And so in that business got me into finance. I got into dealing rooms. I was teaching people. I was supporting a product about to do with technical analysis. So it was all about, I had to learn technical analysis because I couldn't train people in technical analysis to use the system without knowing what it was. So I got John Murphy's Guide to Technical Analysis of the Futures Market, and I started. And I realized that technical analysis was an easy way of visualizing everything that's going on, what had gone on in the past and what might go on in the future. So it became a visual roadmap for me. I was like, great, I can start to understand stuff. I wasn't yet able to plot together all of the different themes and the moving parts. That took me several years of learning from others in how to put together the overall big picture. But yeah, so that's how it all started.
Yeah, I've heard you say that charts leave the hints, right? And then you pair that with fundamentals to tell the story. But that was one of your earliest lessons in finance, was to start with the charts.
Yeah, and that's the same lesson. For example, I did an interview with Mike Novogratz on a masterclass series a long time ago on Real Vision. And the thing that he said was, I said, what happens if you couldn't see a chart? He goes, well, it's like being blind. He said, I couldn't trade. And Paul Tudor Jones was the same. He'd said, look, everything starts with a chart. If I didn't have a chart, I couldn't trade. I don't think Stan Druckenmiller could trade without a chart. I don't think George Soros could trade without a chart. So everybody needs the chart, because particularly in macro, what we do, because you're trying to piece together this enormous jigsaw puzzle of hundreds of different parts. And what the charts do is give you a very quick visual representation of all the knowable information that's in the price.
Right. Now let's jump into present day a little bit. I recently saw an interview that you did on February 5th. And so this is really prior to COVID really essentially capturing the mainstream's attention. But you were paying attention to it, and a comment you made was, this will be the catalyst, and I'm paraphrasing, this will be the catalyst for the US recession. And that'll be met with enormous stimulus that will fuel sort of the hopes and dreams of a market rally. Things might return to normal. That will be followed by the real crash in 2021. Now, lots changed since February 5th, but does that sentiment still ring home for you?
Yeah, nothing's changed in my view. I've said, and I've explained to many people, there's three phases, I think, of how this plays out now. First caveat is I can be spectacularly wrong, even though I've been really quite right for a while now. That does not mean that that's going to hold true. But my thought process is, We had the liquidation event to start with. That was the panic. The financial system froze up. The Fed needs to inject liquidity. All the central banks around the world. Oh my God, our banking system won't function. Money markets won't function. And we need to help all the people who've lost income. Phase one. Phase two is the hope. Oh, we've given money to people who need income. We've injected the liquidity, and the rate of virus expansion is now falling, and we should get more mobility, and that's going to be a rebound. That's the hope phase. I think we're pretty much completing that as we speak. The question is what is the next phase? We either return to normal in some slow way, which the market is pretty much priced, or I think that when you have a huge amount of outstanding debt and reduced cash flow, I don't think growth goes back to normal. So just a reduction in cash flow. So we're not talking about negative 10% GDP, but just like a negative 2 or 3% recession numbers after just eviscerating everybody's cash in the last 3 months. There's no cash left. Mm-hmm. The government's been trying to paper over the cracks for everybody, but corporations too. There's no cash. So you're going to start having lower cash than is needed to service debts. And that's called a debt deflation. Mm. That comes along hand in hand with deflation in prices, which we're seeing everywhere. The forward-looking CPI looks like around the world it should go to -2, -3%. Well, with rates at 0, what do the central banks do? You know, everybody's in the same boat, not just the Fed. Well, what that means is real rates go up. So you're tightening interest rates in the middle of a recession. That's what it does. It means it's harder to pay your debts back. Mm-hmm. Because basically you're getting less income, which is what deflation really means to you. So if that's the case, then the chances of a massive insolvency event go up. And I fear the insolvency event. I think people don't understand the difference between liquidity and solvency. Mm-hmm. Liquidity is right, I'm not going to do anything until you give me some cash to allow me to just lend it to that guy and do that stuff. Because if not, I don't know what's going on. That's liquidity. That's what 2008 was all about.
Right.
Solvency event, you know, Canadians will understand this because they'll have seen it in the mining industry. The mining industry goes through solvency events every 20 years. Mm-hmm. And half the people go out of business. And then, you know, you restructure the whole space and move forward. That's solvency. Right. And the reason that happens in mining is because mining is cyclical and prices are too low for people to have cash flow to service debts. Right. It's very common. Most people don't understand that in the economy. They just don't believe that happens any longer, but it does. And it's going to happen to companies like General Electric, Ford, you know, even potentially AT&T, who's the world's largest borrower. So there's some huge, huge issues. And I think this is what plays out over the next 18 months. This whole big drop in the data, everyone kind of understood, right? That was the liquidation phase. Then what everybody said is, well, it's probably just going to come basically up to normal, but take longer to get there, right? Because it came down in a month and a half. And let's say it goes up over a 6-month period or 5-month period. So equity investors were starting to say, well, we can look through that. Interesting enough, bonds didn't say that at all. Bond yields have continued falling. So bonds are telling you, no, there's something wrong here. Mm. So step back, because most people don't understand all of this stuff. Step back really simply. Is your restaurant in your street going to have the same business, more business, or less business than it did this time last year? Ignoring the fact that we might all try and rush out and get a meal somewhere else because we're bored of our own food. But after that, are we going to go with masks in a socially distant? It's always going to be less revenue. Mm-hmm. The concerts you go to, gone. The conferences, for the time being, gone. All of this stuff, gone or reduced. The amount of socializing you do, reduced. The amount of expenditure is reduced. So that is where cash flow disappears. And that doesn't look like, and people get confused, that's not ongoing, you know, negative 10% GDP, negative 15% GDP. What it is negative 2 or 3, which looks great from here. Mm. It won't look very good when it drags on for 6 months or 9 months. Right. Because that's a proper recession.
So the insolvency crisis hits everybody. We're talking about at the sovereign level, the corporate level, small business, and consumers.
Really, in the US, it's student loans at household level. It is
Auto loans?
auto loans, and obviously mortgages. But and that's always relatively tight, and that always moves up and down with the recession. But those other two are big and outstanding. The corporate debt levels are ridiculous, and corporates basically wasted capital by buying back shares and issuing debt. That huge amount of debt is of no use to anybody because it didn't buy any productive use of assets. So that whole thing is all outstanding. And then when you get to, government level, now the US, for example, or Canada or the UK or whatever, it's not really that much of an issue because you can run, as Japan has proven, huge amounts of debt. But the debt side of the equation is going up fast. And then you go abroad, and in the world, there's $12 trillion US dollars that people are short, where foreign companies have borrowed. That's not foreign sovereigns, that's foreign corporations. So we've got this huge amount of borrowing that's out there that requires cash flow. So if you think about, at another level, you think about Saudi's balance sheet. Well, as an economy, they plan for dollar revenues from oil. Well, when oil goes to, where is it today, $28, well, that's a 50% reduction in what they were. Now, oil may be at $28, but again, a lot of this is bouncing around. Let's call it the blended rate will be about $15 over this period of time. I mean, they've completely destroyed their revenue streams, yet they have dollar-based debts. And that's happened to everybody, whether it's the Indonesian palm oil producer or the Russian nickel miner, they've all got the same problem. So you've massively collapsed dollar cash flows around the world. And that creates a big problem in its own right.
Yeah, and in the short term should lead to a continued surge in the US dollar. Is that right?
Yeah, and that's how I see it. See, everybody else says the Fed are printing money, rates are at zero, maybe they go negative, therefore the dollar collapses. It doesn't work that way. Currency world is a relative world, and there's a supply and demand issue. And we live in a world that is defined by the dollar standard. I don't think any single currency has dominated the world as this has in the last 400 or 500 years. So this currency, the dollar, is 70% of all trade around the world, of all currency transactions. Now, the problem is the US discovered shale. So they stopped buying oil from others, or as much oil. They started reducing the trade deficit, just at a time when foreigners had borrowed record amounts of dollars. And then the US started trade wars, which puts less dollars in the system. And then that created a slowdown in global trade, which meant that the price of commodities fell and the price of oil fell. And that put less dollars in the system. So basically, all of these dollar borrowers are playing a game of musical chairs. And every day, somebody takes a new chair away.
Right.
And the weakest creditor has to give up. Or they have to pay up for those dollars.
Now, could this not, in a way, be self-defeating for the US? They've lent out, $12 trillion of the countries, foreign countries are short US dollars. Simultaneously, the US is cutting off US dollar cash flow to a lot of these countries that have borrowed. That compromises the lender, no? At what point does it become a US problem? This money's been lent out and just won't
Well, interesting enough, it's not the US that's lent it to them. So this is the magic of the euro-dollar market. Now, don't confuse this with euro-dollar, the exchange rate. This is the euro-dollar interest rate futures, the interest rate markets, which are the offshore dollar lending markets. So a bank like Deutsche Bank or HSBC or UBS or credit can create dollars in the system via the euro-dollar markets. And that is the problem. So it ends up on these banks' balance sheets. That's where the lending issue lies. Now, they may repackage it and sell it to insurance companies or pension companies.
Sure.
It's not clear. But it's the foreign banks and their counterparts with the corporations. Now, the issue is the Fed issues swap lines to many of these countries. That's okay. So you give it to Europe. Europeans take the swap lines, which is basically a short-term loan, and they lend it to their banks. The bank's like, thank God for that. I couldn't get any dollars. We needed that. But just the fact that they go, thank you, means they're not going to lend it to you. They will only lend to their best creditor because they need the money as well. So what happens is the marginal creditor starts falling by the wayside, and that whole mechanism feeds on itself.
And this is essentially the beginning of what you've called the biggest insolvency in recorded history.
Yeah, I think, look, the potential is there. And again, I don't deal in certainties, but I think this is a high probability event. And the high probability event for such an enormous call, I'm talking about, 60% chance of this happening. So it's my favored probability that we're going to go into a big solvency event. How that plays out, that we don't know yet.
Got it. So how are you positioned then, Raoul? If this is in your periphery on the horizon, what does your portfolio look like right now?
So at top-down macro level, my personal portfolio is 25% gold, 25% Bitcoin, 25% cash in the bank, and 25% trading opportunities.
And is that cash US dollars?
Yeah.
It is. You're 25% gold, 25% Bitcoin, 25% cash.
Yeah, and then within my trading opportunities, most of my bets are long bonds, long US dollars, and long gold miners, stuff like that. So it's very concentrated in these kind of themes. I'm not short equities yet, but I'm looking to start shorting the big indebted US companies,
right.
General Electrics and the AT&Ts and that kind of stuff.
Okay, now why such a massive bet on Bitcoin?
Because, and again, that's my liquid, available investment money, right? So that's not total net worth, because 25% total net worth is a lot, unless you happen to be very early and you've kept it all the way through. Then some people end up with huge numbers like that. Bitcoin, it's very simple. The dollar standard is going to break the system. The dollar has eaten all of its competitors, and now it's going to eat itself by going up too high. There's almost no way of stopping it. And all the central banks have talked about it. They know it. And they know that they want to move to digital currencies and create a new way of moving currency around the system. It doesn't necessarily just involve the US at the center of it, the infrastructure at the center of it, and all the current market dynamics and structures that we have. There's a number of other things you can do when you move to that, is you can create these very efficient digital baskets. So like Libra, which is the Facebook idea. But anyway, we are moving towards a digital currency world. Bitcoin acts like the gold, the collateral, the personal reserve asset that everybody needs. It's kind of the truth in the digital world, while gold is the truth in the currency world. Doesn't necessarily make Bitcoin a currency, but it makes us extraordinarily valuable store of value. And also, as that entire space grows, as we move into decentralized finance, we move into tokenization, we move into the full digital realm, the Internet 3.0, well, the poster child, for at least for a while, is going to be Bitcoin. It can be Ethereum, it can be a bunch of other stuff as well, but really it's that. And if I look at the chart, always start with the chart looks like it's going to $1 million. And I just can't see it any other way. Now, how long does that take? Probably 5 years. Find me a single other asset that's going to give you 100x asset. Not a share price, not a junior miner that's, just that nobody, find me an asset, an entire asset class that could be 100x. There isn't one. That's why the magnitude of opportunity with Bitcoin is like nothing I've ever seen before. And it's also that whole kind of vortex of people getting into this. They start with understanding a little bit. Then they don't trust it. Then they question themselves. Then they don't know. Then they start to learn. And once you learn, you realize the more and more and more you learn about it and the ecosystem, that it's basically blown your entire mind. And everyone becomes a complete groupie to it. And I've seen the greatest macro minds in the world, with the latest one being Paul Tudor-Jones, who've gone, I get it. The opportunity set is bigger than anything else in the world. But let's go at a really simple level. We are going to move to a different financial system. We have to. that is commensurate with the modern age of the internet. We cannot pass money around. It takes me 4 days to get from Cayman to Canada. You know, all of this stupid stuff that goes on when I can do it literally in a few seconds. Mm-hmm. We're living with legacy systems in terms of lending, who owes what to whom, custody, trust, all of these things that are going to change. Bitcoin is basically the share price of that.
Sure.
And it also has a tremendous store of value. So while the world is basically debasing fiat currency, Bitcoin, on the other hand, is hardening its currency because the algorithm every few years reduces the supply of Bitcoin, which is the absolute opposite of all other asset classes. So it makes it extremely hard as an asset. And it's just about faith. And I think at $10,000 a Bitcoin and a market cap of 200 billion, we're pretty close to saying, okay, there's enough people that have faith and adoption in this. The next phase is, where does it go from here? And speaking to many of the big family offices, investment funds, everybody else, basically the entire world is short the upside of this. If Bitcoin goes up to 20,000, the next skeptic's going to go, Christ, okay, I get it, I need to get in. If it goes up to 50,000, half the endowments, half the family offices, all right, we're going to have to get in, because this is, the more it goes up in market cap terms, the more meaningful it is. Because it's not just a super spike that goes up and down like tulip bubble, right? Mm. It comes over time, a growing adoption. And what it is, it's a growing adoption to a new entire system.
And 5 years is a very short timeline in my view for that kind of a gain. What does that world look like? What has to happen?
Bitcoin already is the best performing asset price in all best performing asset in all recorded history, right? So nothing has ever performed like this has.
Okay.
So it would be a slowdown of the rate of change of growth to say $1 million in 5 years.
Sure. Okay. Yeah.
It would be a slowdown. We did about the same gain in 2017 alone.
Yeah. Yeah, that was wild. Yeah, we were running a tech conference in Toronto, and it was anybody talking about Bitcoin, people were pulling down the drapes trying to get in the room, which to me was a big red flag, right? You know, when you see that kind of activity on a investment conference floor, you're like, okay, maybe we should pump the brakes here. Okay, now, so if this occurs and Bitcoin ends up, you know, $1 million per Bitcoin in 5 years, what do our lives look like, Raoul? Like what happens to the dollar in that scenario, the US dollar?
US dollar is not going anywhere, but it just has to be used less, right? I don't want to buy goods from China in dollars. So you're a Canadian, you buy goods from China in US dollars. Why? That doesn't make sense. What would actually be better? Because you've got all the currency fluctuations of a currency neither of you has control over. Right? That's just a pain. We've got this multi-trillion-dollar per day trading market of currencies. It doesn't need to exist, really. So imagine if you could create a basket, a global basket of currencies, which was yuan, yen, Aussie, Canadian, pound, euro, Korean won, and US dollars. So let's say the US dollar now wasn't 70% of that basket, it was 40% of that basket. And you agree that you're going to use the digital currency basket 1.
Okay.
And that is your reference price. Well, great. That makes a huge difference to everybody because the price doesn't go up and down because of currencies. What you're finding is the price of that currency fluctuates from global money supply or fiat currency printing or whatever format of understanding that you have for it. So it's much less volatile. So it stops. That could stop a lot of the cyclical boom busts of emerging markets.
Right. Now, how does that impact the United States as the global powerhouse and their influence?
You know, I don't know. Geopolitics is always very alluring because it always sounds very smart. Nobody's got a clue. So I've never paid for a geopolitical analyst or strategist in my life because it's just, I don't know. I mean, I can create 2 arguments for that. You could say, well, it's the end of the empire, or actually, if we can create a more stable world where debt the US has a propensity, being the reserve currency, to accumulate a lot of debts. So maybe if things were on a blockchain and things had changed in how we did things, that we would have a more robust financial system. Maybe it allows for less leverage. So maybe that makes the dollar-based system last a lot longer, but just in a different format. So I don't really know. So I'm not the guy who says, well, the dollar goes up, then it collapses, and all fiat currencies go to nothing. It's hyperinflation, and we all go to gold and Bitcoin. I don't believe in that at all. I believe that the dollar is a very, very big problem that needs to be solved, like the dollar was in the 1930s. Mm-hmm. We will move to something different, and that the process of getting from here to there involves a lot of printing of money and a lot of things going wrong. And therefore, the dual aspect of gold and Bitcoin at the same time actually works very well.
Can I ask you about your portfolio allocation and methodology? I was surprised you're weighted so heavily in gold and Bitcoin, and I love that. When I consider my portfolio, for example, I tend to put things in 3 buckets, right? I've got like the insurance bucket, which is I put gold in there. I put Bitcoin in there, actually, same as my life insurance policy. It's the things that I hope to never, ever have to liquidate. And if I ever have to, it's because of some variation of a horrible crisis. And then investments, ideally, that pay yield, dividend paying stocks, cash flowing assets, et cetera. And then speculations, right? And speculations, my business, it's, early stage venture stocks, where I spend a lot of my time and see most of my opportunities. I wonder how much of a wake-up call the crash in March was. And ideally, we'll get a lot of people thinking about how to adjust their personal wealth and their portfolio allocations. And if we're set up for this, we're going through this false dawn right now and another crash coming in 2021, it's almost like we had a practice run in March. And now we can maybe make some adjustments to better prepare ourselves for, what's likely going to occur in the near future.
It depends. If we're talking at personal level, there's 2 things I always advise everybody. He who has cash in a recession is king, because you're the guy who can buy stuff when everybody has to sell it. We talked about, you said, well, if I really have to sell my gold in a crisis, I've got it for that. Well, great. I want to be the guy who buys it off you.
Yeah.
You know what I mean, right? And also having cash gives you a buffer. If you lose your job, if your cash flows are down, you're running a business, you can survive. Mm-hmm. So that people never value. There's a real weird thing in society that they don't value cash. Capital gains above all things, which is madness. No, cash is what smooths out your own personal cycle. And you can't mess around with this, because people get really hurt in things that are going on now. And because people have deemed it acceptable, societally acceptable, not to have any cash, to run as much debt. Cash, and the other thing that people massively undervalue, which they won't do soon, and once they understand solvency, is income. Income is crucial. And it's not income promised to you by somebody else. The best income you've got is yourself. How do you generate income? And if you can generate a few sources of income, again, you up your level of security in bad times and up your level of opportunity in good times. So cash plus income, I think are the 2 best things. Everything else is noise. Now, if you want to bet on the future, depends how old you are. But yes, I like the dynamics of Bitcoin, because that gives you a bet of not equities at all-time high valuations and bonds at all-time low yields and property at all-time high value. I mean, what set of opportunities do you have? None if you're young. So again, it depends where you are in the cycle. If you're older, then you probably want to look at gold and owning more bonds, because they look like cash, and you won't lose everything in a credit event where a lot of the most pensioners have corporate credit and equity as their 2 main risks. Well, in a solvency event, both of those collapse.
Now, there should have been a lesson, I think, in the last 2 months about the importance of cash and income, and potentially this was blurred because of the speed and aggression of all these stimulus packages. Tell me what you think about this. If I should have learned, I didn't have enough cash and I should have had multiple streams of income.
It's very simple. Everyone's taken one bet. everyone said, every single government around the world said, right, we'll give you 3 months of cash flow.
Mm-hmm.
That's the bet. We'll be okay after 3 months.
Yeah, right.
Well, the ticking clock's coming, and I see June coming pretty fast. As I don't see any cash flows come back, so it's either more stimulus, but at a lesser rate, because you can't just backstop every single business and person. Well, before you know it, you're going to start running lower on cash. So there's already the narrative, some people got benefits that made it, they earned more money than they did when they were working. Yeah, but it's not going to last. What are they going to do with that extra capital? They're going to save it because it makes sense to.
Hopefully.
So the more everybody saves money, the more consumption goes down, the more likely there's no cash flow for businesses and people who are in debt. And there it all is.
Mm-hmm. And I hope you're right that triggers savings. I heard you talking with Kyle Bass last week or the week prior, and he didn't put a number on it, but the words he said were many Americans are earning 20% more today than they were when they were employed.
Which for 3 months.
For 3 months. Yeah, absolutely. But can that not lead people down the wrong path to say, if there's a crisis, the government's going to take care of me, and therefore I don't need to act any differently than I used to?
But my point being is wait after 3 months.
Yeah, okay.
And they will learn that the government was only there quickly.
Yeah, got it.
The government's dealing like this, like it was a hurricane, which is an event, wipes everything out, everything gets rebuilt. Eventually, there is a period of time in the middle. But this is not that.
Yeah, and I think, as a small business owner, I've appreciated a lot of the subsidies that have been thrown our way, whether, I run a remote office, so I don't have a lease to defer, but, my bank's been asking about that, and things like payroll subsidies, all of this, and it keeps you afloat. It's appreciated. It makes me super nervous because I wonder, when am I going to get the bill for this, right? There's no free lunch. And eventually the sympathy, like you said, the sympathy is going to wear off, right? You can't sustain this forever. And if there's a second wave of the pandemic in Canada, the US in September, October, it would be foolish to think that we can just have a repeat, a do-over. Wouldn't make any sense.
No.
Right.
But I do know that the central bank balance sheets are going to continue to expand, because I don't think the slow growth is going to go away for a long period. And it's going to freak them out once they start seeing deflation coming in. So I think there's a lot more to come. Which is another reason I'm bullish on gold, and another reason I'm bullish on Bitcoin, because I don't see that stopping.
Mm-hmm. Yeah, I really enjoyed listening to some comments you made comparing the potential for the U.S. to enter a stage like Japan did. Essentially 30 years flat markets. Europe since 2000, maybe the U.S. in the 30s, maybe Taiwan, and it's a picture that's hard for people to wrap their mind around, that the US can't continue to grow.
So if you look at the UK equity market from 1700 to 1950, 250 years, period like this, up and down, right? That's when the UK was the most powerful country the world had ever seen. So why is that? Well, it just traded the business cycle. We didn't get PE expansion on a secular level. That was driven by the rise of the pension system and this massive outsized group of baby boomers. So I think we default to what we know in our recency bias. But to think of the UK economy with the largest companies the world has ever seen, don't forget, the East India Company owned countries. It's by far the biggest company the world had ever seen. In comparison, dwarfs everything we got now. All of this stuff, it's all been done before. I know everybody thinks they're smarter and better than all the past. Not really. In the end, this kind of things are cyclical, along with the economy. And so I just think this is a secular wave driven by a demographic bulge and the rise of something, the pension system, which I think by 20 years' time, we won't have the same pension system, and we will have a demographic bust and not the bulge, because the millennials are not having kids at the same rate, and Gen Z will have even less kids.
Right. So Raoul, if you were, a 30-something, relatively footloose and free, and you were not tied to any geographic location. What countries stand out right now as being having exceptional opportunity, and where would you avoid?
I generally avoid the aging demographic Western world, particularly because a lot of the people who'll be watching this are kind of interested in finance. Well, all the finance industries are shrinking. The opportunities, yes, the US still, and Canada, and most countries still have opportunities to be an entrepreneur. Understand that. I quite like somewhere like the Cayman Islands or Singapore. And the reason being is because if you're a 35-year-old, your taxes are going to have to pay for the mistakes of all of these people who are bailing out, which is the baby boomers. So you might as well go to a place that you don't pay tax. Now, it's expensive. I mean, it's not cheap to live in the Cayman Islands, for example, or has a lower tax regime. So that gives you a start. They're also entrepreneurial countries by nature, and it gives you an ability to build something. In the globalized world, we've all learned that we don't have to go into an office in Manhattan or Toronto or wherever. We can be anywhere. So why not be on the beach in the Cayman Islands, or why not be in Singapore?
Sure.
When you're an hour's flight from most of the countries you need to get to. So that whole thing I think is interesting. I think if you're even more radical, then you can look at, I think India has enormous opportunities. It's got a young population, relatively low debt, high household savings, and there's 1.3 billion people. They've got a lot of great education system at the top level. There's a great opportunity within that country. You don't get many of those. We saw China. India's the next. The next 20 years probably belongs to India.
Now, aside from Real Vision, what is a news source that you cannot live without? Twitter. Oh yeah, I've heard you say that's your number one.
I don't use anything else. I'd love the old world if I had more time. The modern world of digital technology means we have less time. So the world that I used to get on the tube and read the FT, I don't have anymore. And I really miss that because it was quality reading. But now we consume media en masse, and it's a just different way. And the fastest, quickest, most efficient way of curating all of my media is to get my friends and the people I trust on Twitter to do it for me and follow the brands that I like.
Once again, it's back to that trust methodology, right?
Yeah, that's right. And if after a while somebody starts feeding me stuff that I just think, I don't trust this, I don't like it, they've got too much of an agenda, I'll just mute them or not follow them for a while. And then I'm not trying to get into a filter bubble either. That's the other issue of following only the people you trust. You need to be careful not to get in a filter bubble. So I try and keep it wide. I try and have people that infuriate me in my feed, but they're smart, and I trust them to be saying, look, this is an alternative point of view. And that matters to me a lot. What I don't want is just to be fed my own biases back at me. But I do want people to curate my information for me, and for me to curate it for others. It's a hive. I love that kind of open source idea that we're all open source curating each other's news.
Okay, Raoul, most influential book you've read in the last year?
The Hard Thing About Hard Things by Ben Horowitz.
Interesting. That was just recommended to me by a good friend. Okay.
It is the truth about running business. Every other business book I've ever seen, particularly startup books, are, well, we started in a basement, then we had a cool idea, and then we had a little bit of trouble, and then we all became billionaires. Right? That's basically the storyline.
Yeah.
The hard thing about hard things is not that. It is like a boxing match that you have to go 15 rounds. And Ben Horowitz's whole description of what it's like to be an entrepreneur and what it takes and how to deal with situations is truly extraordinary and so useful. It's like a Bible.
Okay, very cool. I've got it ordered from Amazon, and when it arrives, now I've got 2 votes, so that's awesome. Okay, is there a close second? Anything else that comes to mind? All-time favorite?
I think the book everybody should read to understand now is Lords of Finance.
Okay, yeah. Recommended to me this month as well.
Liaquat Ahmed. That's an extraordinarily good book. And also The Great Crash of 29 by J.K. Galbraith. They're just useful background reading. And again, I am suggesting that it's similar to the 1930s. And the reason being was 1930s was the last time we had a solvency event.